Welcome to the National Credit Awareness and Resolution Association podcast at NCARA.org, your source for navigating debt repayment challenges during tough economic times. Today we'll explore how small business owners can more effectively use Creditor Tools, specifically pricing, interest rates, and fees. NCARA aims to bridge the gap between debtor and creditors as a paradigm shift allows debtors to propose their own repayment solutions. Let's get started. The interest rate offered should be based on the credit risk in the deal. All things considered, the stronger the financial statement, the better the interest rate and fees. Competition will make sure of that. What goes into determining the interest rate? The established rate will need to be sufficient to cover the creditor's cost of funds used to fund the subject loan, the overhead or the cost to service the loan, potential losses that may incur, and a reasonable level of profit. Lenders operate on a very thin margin. Management will have internal pricing criteria, and experienced lenders will know the necessary pricing and fee objectives for each loan. Pricing can change as competition and other risk factors are realized. Unless you live in a closed market, creditors will not likely seek to offer the lowest interest rates and may be willing to lose a deal due to underpricing from a competitor. Creditors will also consider the monetary value of compensating balances or deposits you have. The deposits a loan customer is willing to bring to the relationship and adjust down the pricing accordingly. Many loans are granted on a variable interest rate basis, where a certain margin is tied to the prime rate or the base rate, for example, as quoted in the Wall Street Journal. The pricing structure may also have a floor rate or a ceiling rate that reflects how low or high the interest rate may be adjusted in a given period. As the base rate changes, so will the rate on the loan change when adding the margin percentage. Consumer loans will frequently have a fixed rate structure for the entire term loan, as well as some longer-term commercial loans, like, for example, interest rates to be adjusted every 5 years or upon maturity or renewal. Creditors can face strong pricing competition, but will try to win over deals with excellent service. So why is all this important to you? Are you subject to higher interest rate risk, including refinance risk? Small business owners like you need to immediately and seriously reassess the level of debt on your balance sheets for the sake of your own survival. In too many cases, heavy debt rules the day, and most of the debt is accruing interest on a variable rate basis. The rate's going to change. We are now in a high interest rate environment. It isn't as high as prior decades, but as a percentage of increase over the low interest rate environment of the past 10 years or so, the jump in rates is huge. It's huge, especially with the high debt loads in the marketplace that are subject to the higher interest rates upon renewal. There have been mixed signals, 2024 being an election year and all, of lower interest rates, but still pressure on keeping the higher rates higher for a longer period of time due to high inflation. Of course, not surprising, there was a 50 basis points decline in rates, a reduction in interest rates recently in an election year, right? But talk of any lower interest rates is now being pushed into 2025. What if there are more shock events? You can almost count on them happening these days, right? Think COVID, think wars, and so on and so forth. That may make interest rates increase even more than you might have expected and possibly more sharply than you could have imagined. What then? If you're having a hard time making interest-only payments or minimal amortizing payments, like much of the world is doing, how well would your business fare if your new interest rate was 100, 200, 300, 400 basis points, that's 1 to 4% higher or more? How would that impact the interest expense on your income statement? And what would that do to your bottom line? You might want to have your accountant or chief financial officer stress test your balance sheet and income statement and see what happens for yourself. Run different scenarios like those higher interest rates, maybe even include things like a 10% reduction in sales revenue or a 5% increase in salary expense. Now's the time to do this. What is your break-even point where interest expense eats up most of your budget? Seriously, though, you can project what the next 12 months will look like on a monthly basis. If interest rates increased more suddenly and sharply than you expected starting today, what effect would those economic conditions have on your operating margins, the value of your assets, and your ability to repay? Do it before it hits you and the creditor. Know before you go. This short ad is sponsored by the Debt Crisis Problem podcast. Attention listeners, please join us at tunabudget.com to tune into the Debt Crisis Problem podcast, where in plain English we discuss the 20 risks that could soon fuel a serious economic downturn. We explore critical risks that could trigger these downturns and offer practical insights for navigating financial uncertainty. Join us for thought-provoking discussions that encourage transparency and awareness. Subscribe now to stay informed and ready for whatever comes next. We've not paid enough attention to the interest rate risk. Look, we live in fragile times, and small business owners have paid too little or no attention to the levels of debt they maintain. Soon, small business will find themselves in serious jeopardy, I believe. Think of the words modest and controlled, and consider adjusting your strategic plan accordingly. As you might guess, in a workout situation, the creditor is going to offer an interest rate regimen that makes sense for the creditor. Think higher credit risk equals higher interest rates. If you don't like it and you're able to do something about it, take your business to another lender or sell some assets and retire as much debt as possible. If you're stuck with a creditor, or if the creditor is stuck with you, there's no reason that you cannot address the interest rate treatment straight up. Look at your monthly pro forma cash flow statement and install the interest expense amount your creditor may be expecting you to pay over the next 12 months. If you feel the interest rate is fair and equitable, then fine, pay it. If you don't believe it is fair, equitable, or manageable for your business, then discuss the rate with the creditor and request an interest rate structure that will meet your needs. But don't do the latter just because. The creditor is a business just like yours, and you know what you need to charge to stay in business too. There should be a valid reason and financial need, or you're not likely to succeed in getting a low rate. Look up disclosable loan modifications. It is doubtful anyone can pull the wool over the eyes of an astute creditor, but a wise creditor will listen to a well-prepared borrower. So, prepare a well-supported, assumptions-documented pro forma cash flow statement with the right interest rate. You know your business operation better than anyone. Footnote material sources and uses of cash, as well as interest expense. Use different interest rates. Make a base case, a stressed case, even a break-even case. A lower interest rate is a variable expense option, but you will only get the right rate if you push for it because you need it to survive. Lenders can make concessions on disclosable loan modification terms, but only if it's necessary for your survival, and it has to be completely documented with those pro formas and things. Look at the interest rate risk through the eyes of the creditors too, as creditors are businesses just like you. They still need to be properly compensated, like you do for your products and services. So be careful, be thoughtful, justify your positions. It is what it is, good or bad. Think full disclosure. This includes having a variable or fixed rate. The creditor may be willing to discuss both options, and in a potentially rising interest rate environment, perhaps your interest expense can be locked in at a lower rate, like we did for the last number of years, even if it is at the low end of the higher interest rate range. The creditor will obviously push for the rate that it needs to cover all his costs and make a profit. Thank you for joining us. Today we covered the Creditor Tool, pricing, interest rates, and fees, as debtors prepare to propose their own repayment solutions. But we want to hear from you. Share your own credit risk memo and debt repayment experiences, questions, and recommendations with us at nacara.org. If you found today's episode helpful, please subscribe for notifications of future podcasts. Your feedback helps small businesses stay in business. Until next time, step forward and take responsibility for your own debt repayment solutions. Thanks again.